Good afternoon. I would like to officially call this program to order. My name is Pam Gibbs, and I serve as the Senior Advisor in the Office of the Investor Advocate. Thank you all for joining us today. We have what I believe will be an exciting program ahead of us, and I hope at best what it creates within all of you that are participating today a sense of curiosity, a curiosity to learn more about capital markets and investing as you contemplate your own journey in building wealth and establishing financial security. I have a few little housekeeping notes. One, we will be taking questions from the audience after each panel. If we do not get to all of your questions, please write your name and your email address in the chat box, and we will follow up with you directly. Secondly, I like to offer the SEC disclaimer for the SEC employees, and that is that the views that are expressed here today are ours and do not necessarily reflect that of the commission or the staff at the commission. And with that, I'd like to turn it over to our investor advocate who advocates on a daily basis for investors, Christina Martin Favita.
Thank you, Pam. I'm Christina Martin Fervita. I'm the Director of the Office of the Investor Advocate here at the Securities and Exchange Commission. I want to begin by thanking all of you who have decided to spend some of your time this afternoon listening to this presentation on capital markets and how to think about getting started in investing. This topic of being a first-time investor essentially is one that's really close to the Office of the Investor Advocate, to the Office of Investor Education and Advocacy, and to the entire Securities and Exchange Commission. And it's been an event that we've been looking forward to for a number of months now as we've been planning it. With that, I want to in particular thank Pam Gibbs for organizing today's event, as well as Stephanie Presley and First Generation Investors for co-hosting the event today with the Securities and Exchange Commission. I just wanted to, before we move forward, I just wanted to take a minute to reflect on my own experience as a first generation investor. I started investing when I was just out of school, and I was very lucky to have parents who had a lot of good money habits, but not a lot of money. And at that time, decades ago, there were many more barriers to investing in capital markets than there are certainly today, but even at the time when I got out of college. So when I did get out of school, thinking about all the things that my parents had taught me about money, I made the decision that I wanted to start investing in mutual funds, and I did that. I didn't do it with a lot of cash, and I also didn't do it with a lot of knowledge. If I can be frank, I am sure I made a lot of mistakes, but I am sure that one thing that was not a mistake for me and for the goals that I had for myself was to start early. I am going to now turn it over to Lori Schock so that she can share with you also a little bit about this afternoon. And Lori is the Director of the Office of Investor Education and Advocacy and is someone that younger me would have appreciated knowing then so that I could head into the decisions I made armed with a lot more knowledge. So Lori, thank you for joining today, and over to you.
Great. Thank you so much, Christina. And thank you all for being here today. I know everyone has a very busy schedule, so you're taking time to invest in your future by taking some time to be at this conference here today. So thank you for joining us. I am Lori Schock. I'm the Director of the Office of Investor Education and Advocacy. It's a long title, but let me tell you what we do in my office. We handle the investor complaints and questions that come into the commission. But then we also put out the investor alerts and bulletins, and those are informed by what we're hearing from the investing public. The alerts have a tendency to deal with investment fraud that we're seeing, and we work with other regulators when we can to put out joint alerts. And then the bulletins have a tendency to focus on areas of maybe there's investor confusion or new SEC rulemaking that we're trying to make it where the layperson can more easily understand that 400-page rulemaking. So those are the investor alerts and bulletins. And then we also do investor education through in-person and virtual training such as this one. So I appreciate the opportunity to be here today and to share some of my personal stories as well, and some things I think can help going forward. I wish I'd known my current self when I was younger too. I've learned a lot over these decades of being here at the commission, and I'm always a big, person who wants to learn from someone else's mistakes. So learn from some of mine and not make the same ones. So at this time, I'm going to introduce Stephanie Presley from First Generation Investors, and take it away. Thanks.
Thank you, Lori. Good afternoon, everyone. It's a pleasure to be here at this web conference today to discuss demystifying capital markets. I'm Stephanie Presley, the Executive Director with First Generation Investors, a nonprofit organization that teaches high school students the power of investing and brings classroom lessons to life by providing students with real money to begin investing. We're so delighted to join the SEC here today to co-host this conversation on the importance of first generation and early investors. First Generation Investors was founded by 3 college students, Cole Maddox, who's joining us, Dylan Ingerman, and Alex Ingerman, while they were attending the University of Pennsylvania. They wanted to take a new approach to teaching financial education to high school students. Because of the power of compounding interest, they focused on investing to encourage young people to adopt an investing mindset for long-term financial growth. Through research, discussions with financial educators, learnings from their own experiences, they identified the major barriers to entry in investing. It was knowledge, which we hope to gain some here, the inertia of creating an investment account, and access to capital. To address these barriers, at FGI, we partner with high schools and organizations focused on youth education to host an 8-session course covering key topics in personal finance and investing basics. That includes understanding stocks and bonds, the concepts of volatility and diversification, and most importantly, the power of compounding interest. Our program is facilitated in classroom by teachers or through a network of college tutors. All of our students who complete the program receive the capital to begin investing. Graduates receive $100 to allocate amongst a select group of funds when they graduate high school and turn 18. So these funds are transferred directly to the students' brokerage accounts, kickstarting their investing journey. And what we want to do is provide a foundation of practical financial skills and real investment experience to foster a generation of financially savvy individuals who are prepared to have a successful financial future. I will now introduce Commissioner Hester M. Pierce, who will provide an overview of the SEC's role in capital markets and investing. Commissioner Pierce is a distinguished leader in the field of financial regulation. Before her tenure at the U.S. Securities and Exchange Commission, she conducted important research on financial market and regulations. Her extensive experience includes serving as senior counsel to the U.S. Senate Committee on Banking, Housing, and Urban Affairs, where she provided guidance on securities issues to ranking member Richard Shelby and other committee members. Additionally, she held the role of counsel to SEC Commissioner Paul S. Atkins and worked as a staff attorney at the SEC's Division of Investment Management. Commissioner Pierce began her career at Wilmer, Cutler, and Pickering. She earned her bachelor's degree in economics from Case Western Reserve University and her Juris Doctor from the prestigious Yale Law School. I am so excited to welcome Commissioner Pierce, along with welcoming back Christina Martin Fervita and Lori Schock to join us in our next conversation.
Welcome, Commissioner Peirce. Thank you for joining us this afternoon.
Well, thank you, Christina, and thank you, Stephanie, and First Generation Investors for partnering with us in this afternoon's program. I'm excited to have this conversation, and we'll learn a little bit about the SEC, and I hope talk a little bit about the benefits of investing early, as you already have alluded to. So I'm looking forward to this.
So, speaking of starting early, when we were preparing for this afternoon, Lori and I were talking about how, hypothetically speaking, if you were in college right now, and I'm going to guess a number of the folks who have tuned in this afternoon are, um, if you had $100 and you have a lot of different opportunities to invest the $100 or to spend the $100, why would you consider investing? What would prompt you? What would prompt me, age 20, with $100 to do that right now?
I think whatever you're planning to buy with your $100 probably will be not useful to you by the time you are 30. Whereas if you invest that money in a mutual fund, for example, or even if you decide there's an individual company that you've been following and that you're interested in, you're more likely. Now, of course, it depends upon the investment. You can make bad investments, and you've always got to know that you're potentially you could lose the money you invested, but you're more likely to have that money and then more if you've invested it. And so I think that's the exciting part of this. It's if you decide to defer something that you wanted to buy and take that money and invest it, it actually will you'll kind of forget that you had made that sacrifice, and then when you look at your account, you'll see the benefits of that as you get older.
So, Lori, I see you smiling. I know that you've talked about how time is your friend in presentations I've seen you do. Um, what when we think about investing and we think about time, what is the power of time? Like, why wait? What would prevent you from starting?
Well, time's your superpower. That's it. Um, we look at the power of compound interest and what it takes. If you start in your 20s, it takes so much less money to put in on a regular basis than if you delay it even 10 years to your 30s. And by the time you're in your 40s or 50s, you're having to put in, it's 10 times the amount that you would have had to have put in earlier. So that's the power of compound interest. I will talk about that a little bit later, but that is the superpower. Time is your superpower, and it can work for you or against you. So for those who have time on their side, take that $100 and let's if you can invest it. If there's a certain product that you like, instead of buying the product, maybe invest in that company. Don't do what I did with my $100, which was I invested in a penny stock. Let me tell you what a penny stock is first. So a stock is an ownership interest in a company. You want it to appreciate in value, and maybe it even pays a dividend. A penny stock is a stock that's thinly traded and generally has a dollar value per share of under $5. But my thinking at the time was that I could get more shares with that. Unfortunately, as the commissioner said, you might lose money. And in this case, with my penny stock, what I didn't realize at that time, this was much younger Lori, was that there's a lot less disclosure with thinly traded stocks. The stock market can move, small amounts of trades can actually move the price up, but when people are selling, it moves it down and can move it down rather rapidly. And unfortunately, that company that I invested in early on filed for bankruptcy, which meant there was no value left other than a very well-deserved lesson. And luckily, I learned it early in my life, and it didn't bankrupt me. And I have to say, unfortunately, some of the complaints that we get, some people sometimes maybe even invest in a company that's already filed for bankruptcy, and they don't understand that generally speaking, when a company's filed for bankruptcy, that even if it comes out of it, a new stock is issued. So, those are some of the challenges, and that's why we want to talk about sort of demystifying what the capital markets are. And so some of the products. So I talked a little bit, with equities, that's synonymous with stocks. Bonds are IOUs, where essentially the principal is supposed to be fairly safe, and you just get interest. But if the company's value goes up, you don't see that return because you've essentially loaned money and you've contracted to get an interest payment back. And then sort of the third part of this is cash, and we know that cash you take no risk, except there's inflationary risk because you could lose the power of how much that dollar can buy. It doesn't buy the same thing it used to. So, there's some things here. That's why you need to be an informed investor and, do your research before investing in anything. But that's sort of where that $100 can go. But that $100 over time has the potential to really become something much greater than it is.
And don't give your $100 to the person who tells you that you need to invest in this today, or else the investment opportunity will be gone tomorrow. And there are definitely scammers out there, so you have to go in with your skeptical glasses on, and as Lori said, do your research, and don't worry about being forced to make a decision. You just take your time and you make the decision. Time is also your friend in studying your investments before you invest your money.
I was hoping you were gonna bring that up, that like time is your friend in so many different ways. I was thinking about how time is our friend in another way too, because as I alluded to when I introduced myself, some time ago, $100 would not have been enough to get started investing. And sometimes when we think about the term generational wealth, we sometimes forget that some generations didn't have the opportunities that we have today to jump in if we want to, if that's the choice we want to make. So I was wondering if anyone else wants to share their recollections of, we used to have capital markets. We have always have had very robust capital markets, the envy of the world. But we used to have capital markets where if you were an individual investor, you really needed to bring a lot more money to the table to invest, to even be able to buy anything, any stocks or mutual funds or bonds. And also that you often needed to uh, work with a professional. And working with a professional is a great choice for many people. But really, the way it was a long time ago, and by a long time ago, I mean, 30 years ago or 40 years ago, you really did need a broker or an advisor. You needed a professional who would perform the job of making the investments for you. Even if you told them exactly what you wanted to buy, you still needed that second person to execute those trades for you. And all those things can be a barrier to get started. So I wonder if anyone else today is um, thinking of other barriers that time has kind of erased.
I mean, I think that's such a great point, Christina, because if you took your $100 in the 70s when I was a kid, and I remember my parents would go to the stockbroker, right? But all of that money would get eaten up in what you had to pay the stockbroker, and now you can get on an app and trade, and that's a great thing. But you also, again, that the ease of doing it should also be matched with careful time of thinking ahead of making the actual purchase, and making sure that that you want to buy what you're buying, and that you have the wherewithal to buy it, and potentially and that you're not going to need that money right away to buy something that you need. So if you need to buy a textbook, you probably shouldn't take your $100 and invest it in the markets if you're buying something that you need immediately. But I think that certainly there are other barriers that have come down just in the sense that people realize these markets are for all of us. And that's one of the things I find really most exciting, which is that the capital markets are a way for you to invest in the society that you live in. They're an opportunity for you to invest in businesses that you believe in. As Lori said, if you are thinking, oh, I'd like to buy this product, you might think, well, wait, maybe I should just buy a share of the company, or so that I can have a piece of this product that I know all my friends really like. I can have a piece of the profits from that. So I think there's definitely more of a recognition now that these markets really are for everyone. And the other side of this is that we also can participate as, if you're building a company, you can participate in the markets by drawing capital from investors. So that's something, as you think about your careers, that you can look forward to being able to go to other people with a great idea and saying, hey, do you want to invest in my idea?
Those are great points. When we talk also sort of the barrier to entry of the past versus the ease of entry now, the rules also sort of changed when it came to retirement planning in the United States. Um, I guess it sort of came in at the tail end of the silent generation, but the baby boomers got hit with it, straight on. What we saw was, the change where people had pensions. So if you worked for, a certain company for your life, once you retired after 30 or 40 years, they would provide you money until you died. Um, and those were defined defined benefit plans. But that changed. The rules changed in the 70s, were implemented in the 80s. And so, we had this new generation coming in, into the workforce with 401ks, 403bs, these other tax deferred retirement plans, but it shifted the risk from the employer onto the employee, and there wasn't a lot of education that went around this. And so, here we have new workers, new retirement plan. What do I do with it? There was also a change during this time with the federal employee retirement plan. We're fortunate enough to still have a pension, but the pension plan changed and the thrift savings plan emerged also during this time. So, that's probably the first way that most people are exposed or historically were exposed to the stock market. Um, because in previous generations, you generally had to have a fair amount of money to invest initially. There were these things called investment clubs because people couldn't afford to have 100 shares to buy 100 shares outright. So they pooled their money within the investment club um, so that they could buy those even lot shares of 100 shares. And you don't have to do that anymore. There are fractional shares, no commission trades. But just remember, there's always going to be a cost somewhere. So, when we talk about sort of the work of my office, fraud, fees, and risk sort of sums it up rather quickly and succinctly. So, just something to be aware of. And Commissioner Peirce made a great point with the ease of getting into the markets that's great, but you still need to know what you're doing, what you're buying, what the rules of the game are. Okay, because when things move against you or you don't know sort of those rules, it can have a detrimental effect. So, do your homework, um, and take a time out. Definitely, if you're feeling pressured to buy anything now, we see that an awful lot in the fraud space. But I have found that some of the poorest decisions I made in my financial life were made in haste. So again, learn from my mistakes. Don't make them yourself.
Well, I mean, I think that point about fees is also really important. If you're getting someone to help you, that person is probably going to be paid somehow, and you want to understand how that person is paid. There's nothing wrong with you asking so that you understand. And you should not feel shy about asking, hey, how are you getting paid for this? Are you on a commission basis? Does it depend which product I buy? Do you make more if I buy product X versus product Y? and you want to understand those, not only how much the person is being paid, but what sort of conflicts there are. So, it's good for you to understand if someone has a particular reason to push a particular investment on you. And if you feel uncomfortable with a particular, if you're dealing with a financial professional, you feel uncomfortable with that person, there's nothing wrong with you just turning around and saying, thank you for your time, but I'm going to go somewhere else to get help. It's like anything else. You find people that you're comfortable working with and comfortable asking questions of. And I think it's really important for you to feel empowered. I know when I go to a doctor, I often feel very shy about asking questions because the person is busy, and you don't really know anything. This person has all this knowledge, and you feel your questions are stupid. There are no, I know this is a common phrase, but there really are no stupid questions. You're handing over your money, and so you have every right to know exactly where that money is going, exactly who's getting paid with it, and exactly what your risks are. And if you don't feel you're getting those answers, you should feel perfectly comfortable moving on.
Um, all of this is making me think about, Lori, you mentioned rules, and Commissioner Peirce, you're talking about, asking questions, making sure that you understand what you're investing in and what you're paying for. And a lot of that goes to the issue that Stephanie raised, that a big barrier that continues to exist for starting, but also continuing to invest. I see this all the time, even with seasoned investors, is knowledge, and just feeling confident that the choice you're making is the right one for you. That is going to entirely hinge on whether or not you understand what it is that you're buying. And the way that we think about that problem at the Securities and Exchange Commission, speaking of rules, is that we have a lot of rules about disclosures, right? And we try to make sure that if you're investing in a legitimate company, they're going to be required to disclose a lot of information to you so that you can decide if they're right for you. And likewise, if you're working with a financial professional, they need to disclose certain things, like Commissioner Peirce was saying about, do they have a conflict, or how are they getting paid? So I was wondering, we all work for the SEC, the three of us. I was wondering if this is maybe a good time to maybe more generally just talk about, how do people, how do we work? How do people know that their investments are legitimate investments? And how do we, at the SEC, and there are other regulators involved too, how do we keep the markets working efficiently and investors protected?
Yeah, let me just give you a little overview of where the SEC kind of fits within the financial regulatory framework. We have a lot of financial regulators in the US. There are some at the federal level, including the SEC. We oversee stock markets, broker-dealers, investment advisors. And as Christina mentioned, companies make disclosures, and we review those disclosures. Mutual funds make disclosures. Exchange-traded funds make disclosures, and we have a process for reviewing those. It's not to say we approve and say this is a great investment, but what we want to make sure is that the person or the company that's issuing a share, or the company that's issuing the asset manager that is trying to sell you a mutual fund or an exchange traded fund, is telling you what that product is. So making the necessary disclosures so that you can make a decision about whether it's good for you. So we have a role there. And then we also oversee the exchanges, how they operate. So we have a role in setting the rules. We examine broker dealers, investment advisors, and the exchanges to make sure that they're complying with the rules. And when there have been rule violations, when someone's not trying to do the right thing, then we can bring an enforcement action against them. We don't put anyone in prison. That's what the criminal authorities do. We often work alongside. We often will bring an enforcement action, and the criminal authorities will bring an enforcement action so that someone can be can be subject to criminal sanctions, including potentially going to prison. But then we also have partners at the state level, so they're state securities regulators, and they're often closer to what's happening in a particular community, and so they can be very helpful for you as investors, but also helpful partners for us. And then there are also other financial regulators in the U.S. We have self-regulatory organizations. One of those that you'll hear about is FINRA, which regulates broker-dealers. And then we have partner regulators who regulate the banks, which is not our area. Lori, I don't know if you want to add something to that because you're.
No, that's a great overview. So the people who sell products are required to be licensed. The products themselves generally are required to be registered. The exchanges on which they trade are registered with us. But it's still up to you as the individual investor to do your due diligence, to read the disclosures that are out there. And let me just tell you, like doing a background check on a financial professional, we've tried to make this just as easy as possible. If you go to investor.gov, that's our retail facing website for the commission. So it just has investor education materials. It's as simple as putting in the person's name. Okay. And you can pull up that background information. They don't know that you're doing a background check on them. It's free, it doesn't cost anything, but there's a lot of information in there. The first thing is if the person is trying to sell you a product and they don't show up in there, red flag on the play. Hang on to your wallet, don't turn over any money. You need to do a lot more due diligence to find out why they're not in that database, especially if they're trying to sell investments. There are some obscure situations where that might be, maybe it's insurance or something, but generally speaking, they should be in this database, okay? So flag on the play if they're not in the database. Let's say they are. What does it tell you? It tells you what their history is, what exams have they passed, what licenses do they hold, how long have they worked with the certain firms, have they jumped around from job to job? Have there been any regulatory issues? Have the state securities regulators filed against them? Have we? Has FINRA brought action against them? And you can find that information and make an informed decision on whether or not you want to do business with that person. And like Commissioner Peirce said, look, this is a very personal decision. One of the things though about trusting your gut, I just like the person. We find that a lot of investment fraudsters are really likable. However, they're not in this database. So that's why you found someone, you think it looks good, but do this background check anyhow, just to make sure. And when it comes to investing, what works for you works for you. It doesn't necessarily mean it's good for your brother-in-law or somebody else. This is, like I said, a very individualized decision, and it's got to work, what works in your best interest. So please, please, please go to investor.gov, do a background check before you turn over your money. And then also when you're talking about, all of these publicly traded companies or products, mutual funds, exchange traded funds, variable annuities, those disclosures can be found in a database called Edgar. Again, go to investor.gov, put in researching your investments. There's a tutorial on how to use Edgar where you can find out these disclosures so that hey, look, this company just filed for bankruptcy. May not be one you want to invest in at this point in time. Or, hey, the CEO's leaving, but maybe it's because the CEO hit retirement age. Okay, fine. But you want to know that information before you're making decisions. Audited financial statements are there. So a lot of disclosure, but we need you to read it and do that homework ahead of time.
And I think, Lori, something that you said that is so important to repeat, and all of those resources are free. All of these avenues of educating yourself before you make a decision, when they're provided on investor.gov or through Edgar, or basically anything that's going to have a .gov extension, they're going to be free because we have to serve the public, and one of the ways we do that is by providing these platforms that let you search all of these disclosures for free. But also, Lori's right. Everyone's different. Everyone is. We all know we're aware that you might get information from lots of different places, not just from Lori, who's terrific, or Commissioner Peirce, who I see do many events and does a lot of appearances, and I always find them really clear and easy to understand. But you might prefer getting your information somewhere else. So I think one of the things that I know we're going to talk about a little bit more in just a few more minutes is um, all the different, in the same way there are fewer barriers for investing, there are a lot fewer barriers for getting financial information these days. I also recall when that too was a cost, right? You would have to subscribe to really specific newspapers or newsletters or very specific journals, and they were very, very costly. And now you can get a lot of information in a lot of different places. It's important, as Lori is highlighting, it's important to just double check your sources and just make sure that you understand where they're getting their information. And ultimately, before you invest, just check, just at a minimum check these resources on investor.gov, where it really is as easy as typing in someone's name.
Yeah, I mean, I think there's nothing wrong with talking to a lot of people about investing, with seeking out information in different places. But you do want to understand, again, if someone's putting a video on TikTok, you want to understand whether that person is getting paid by someone to tell you this is a great investment, and or whether someone is trying to get you to take a class that you're going to have to pay for. And again, that may be something you want to do, but you just want to know what you're getting into. And so always approach with skepticism. The investor.gov resource is there. Not enough people use it. You should always, that's somewhere that you should always think to go before you make a decision. And I think it's just really important to remember too that sometimes people do very, very deceptive things. Like they try to make it appear that they're from the government and they want you to send them money. That's a red flag, huge red flag. Or they try to appear that they're from a legitimate firm, but they're asking you to send to give them money directly or deposit money directly into their bank account. Red flag. You do need to always be asking questions. And again, I just can't underscore that enough. There will always be another investment opportunity. So don't ever feel pressured.
I think before, just one last thing I want to make sure that I get to say before we turn to Pam. I know that she has left time for any Q&A from the participants today. I know that I mentioned that I know I made mistakes, and I know Lori has also shared, one of her investment adventures that didn't go the way she wanted. That's going to happen, and that's okay. That doesn't mean you did it wrong. That's going to happen because investing inherently includes risk. So as much as we're highlighting a lot of steps that you can take to protect your money and to feel at ease that the decision you're making is really one that you like for you, it's still okay if you make a mistake. And investing, because it is such a long time horizon that we have when we start investing, especially early. There's time to learn from our mistakes and to figure out to start again.
I think that's a great point, and I just want to make two other points before we go to Q&A. One is, one way to protect yourself is diversification. So that's a long word for saying don't put all your eggs in one basket. It is good to figure out a way where you can, if you have some money to invest, you don't put it all in one company. You can invest through a fund. I talked about mutual funds and exchange traded funds. that allows you to get exposure to a number of different companies at the same time through one investment. But you can think about other ways to not put all your eggs in one basket. And then Lori mentioned 401k plans when you are working somewhere and they give you the opportunity to participate to invest in a 401k through your employer. That's often something that it's very good for you to participate in. And often the company will actually match the money you put in. That's not always true. But sometimes that is the case. So you kind of get an extra kick to your investment.
It's the only time I ever get to say guaranteed returns, because if the company does offer a match, it is a guaranteed return. If it's dollar for dollar, that's 100% return, or if it's 50 cents on the dollar, whatever it is, it's better than you can make in the market. So yes, try to do your best to get that company match or agency match if you're working for the government.
So I think Pam is standing by. There she is.
Hi, you guys. Thank you for that wonderful discussion. We don't have any questions in the chat box now, but one thing that I've always thought about, and I like to just sort of uh, ask now is one of the things that when I'm talking to particularly underserved communities or underrepresented individuals, there always seems to be a high level of distrust in the markets. And so when we talked about barriers, hidden barriers, I think that's a barrier too. So, if I may, what are some suggestions that you can offer to sort of seal the trust level? I know my decade here at the SEC helped me a lot. I'm not sure that I would have ever invested outside of the TSP or employee uh, retirement plan if I had not spent the last really, even at CFTC, the last 15 years at a federal regulatory agency. So I'm just curious, what more can we do to enhance trust in capital markets so it can be part of a person's portfolio that may not recognize that they can also have investments outside of their employee base plan. Any thoughts?
I mean, I think if you think about what I think we sometimes talk about the capital markets and it sounds very esoteric, hard to understand. But when you think about what is really going on, it is companies who want to either they're either new companies that are starting or companies that have been around for a while but are trying to expand, and they need money to do that. And so they're trying to go out to other people and get money so that they can expand. And this is the capital markets are your opportunity to participate in those companies' growth. And so it makes sense that the public has an opportunity to participate, that it's not just a few people who own this big company, but it's many people, and every one of those people gets a chance to participate. So it really is a whole part of the economy that opens up to you through these markets. And I understand that there's a lot of fear about trusting people because people have heard stories about other people getting taken advantage and so forth. But that's where knowledge really is power. And that's why we've been hammering investor.gov. You can take the time to learn about these investment products. You can take the time to learn about what is the SEC, what are the different options available. And then you can go in well armed with knowledge and you can feel comfortable. You'll know what red flags to look for, and that really will enable you then to participate in the growth of the economy around you. And that then is so powerful, not only in building your own future, your own ability to retire, to buy a house, and so forth, but also then in passing that on to the next generation, which can make the difference. It can be enough money so that your child will be able to take a year to go do a study abroad program or something like that. The choices you make now as a 20-year-old can set up your children down the line for some really amazing, interesting life experiences. So look for the future benefit as well.
Thank you for that, Commissioner Peirce. Anyone else like to add before we close out?
Let me just add a little bit tag along here. When you're talking about, trust or distrust of this, all we can't say that past performance is going to be indicative of future performance. However, all we have to talk about is the past performance. And you look at, say, the S&P 500, which is an index that tracks the 500 largest stocks, largest companies in the United States. The historical return for the S&P 500 is around 10%. And if you do inflation adjusted and all this, it ends up being around 7%. That far exceeds the historical bond returns and certainly interest that's paid on cash. And so, you know, which is the bigger risk? Not participating, not getting those returns? Because if you don't, you're going to need to make up, that difference some other way, which means you have to save a lot more, which means you have to make a lot more. So it's that compounding power of interest that we talked about earlier, that really can determine, like the commissioner said, your financial future and what's easier or harder as you get older. And one thing when it comes to, I hear people sometimes, I'll just work for the rest of my life. It sounds good for a retirement plan until, say, you have a health issue or some other reason where you're unable to work, or you lose your job, say in your mid 50s, and you may get another job, but it's not the same type of job. So, those are life events that you have absolutely no control over. How you spend your money, how you save your money, and how you invest your money is something you do have control over. Also, a big part of this is needs versus wants. So, put off the wants and make this, pay yourself first and do this on a long-term basis. I've never heard anybody regret saying, oh, I wish I'd started later. They always say, I wish I'd started investing sooner. I wish I knew about this earlier. So you have an opportunity to know something, now do something.
And the only thing I would add, Pam, is that I know sometimes I've heard Lori also give presentations where she will share. Everyone makes their own decision, but it's never a bad piece of advice to invest in things that you understand. And if it doesn't make sense to you or you can't understand what it is, maybe it's not. Maybe it's a great investment. Who knows? But maybe it's not the best investment for you. I have personally found that my trust in my investments is deeper when I feel really confident that I understand what the investment strategy is and what this company is hoping to achieve. Not only do I feel good about what I'm doing with my money because I understand it and then I picked to do that with my money, I also just have an easier time following what is happening with that strategy. Do I need to change or adjust that strategy? And when I start second guessing myself, because I never understood what I was doing in the first place, that's when my trust erodes. And that's when I want to kind of get out and get panicky. And those are all normal feelings to have when you're investing. But for sure, having that rule for me personally, like I only want to invest in things I understand how they work or what the strategy is, has increased my own confidence and also just my trust in the whole market.
Commissioner Purse, did you want to provide last more closing remarks for the panel before I call the next panel up, or are you okay?
Yeah, thanks, Pam. I just wanted to thank everyone for being part of this event, and I look forward to perhaps being able to interact with some of you in the future, maybe as employees at the SEC someday. So look into the financial field also as a place where you might make your career.
Thank you for that, Commissioner Purse. And thank you, panelists, Lori, Christina, for an excellent, outstanding job. And so if now I may call the next panel up for discussion. Bye-bye. Cole Maddox, Chelsea Ransom Cooper, and Kelly Howes. So now, thank you guys for that wonderful overview of capital markets. Now we're going to move into a session where we begin to hear from investors and how they got started and their pitfalls. We have Cole Maddox, co-founder of First Generation Investor. Kelly Howes, partner at Morrison and Forster, and Chelsea Ransom Cooper, from a certified financial planner from Zenith Wealth. Thank you guys for joining us. So if I may, I'll start with you, Cole. Can you please just share with us how you began investing and why?
Yeah, absolutely. So I was pretty lucky to have a very early exposure and experience with investing. I had family that were investors themselves, but also one of my first experiences, at least with not just investing, but specifically investor education, was actually in high school, where we had a economics class and they presented to us the stock market game. And the premise of this, and this is a real educational course, is try to make as much as quickly as possible, which is the wrong approach to investing. So one of the biggest reasons in terms of starting first generation investors and sort of embarking on this journey of long-term, sort of buy and hold investing and financial literacy was the, need for sort of proper investor education. So, there's a lot of information out there, and there's a lot of, different sources where you can get information, but it's extremely important to just sort of remember and stick to the fundamentals.
Kelly, if I can switch to you. Thanks,
Sure.
Cole.
Sure. I did not have anyone in my family who was involved in investing. I grew up in a small rural town in upstate New York. My mother was a single parent. She was a bank teller, 3 kids. There was not a lot of investing going on, but my mother was very frugal and she was a saver. And so she did definitely instill in us, the need to understand what your day-to-day needs are for living, and not to try to not sort of overspend yourself. When I got out of college and into the workplace, I was lucky enough to work in organizations that had 401k plans, and those 401k plans had matching employee matches. So as Lori said, I learned very quickly to sort of make 100% return on my money by at least pulling out of my paycheck every pay period the same amount that would be matched. I also learned, much to my surprise, that after about the first couple of weeks, I kind of forgot about that, right? Like I wasn't looking at that for income. It was immediately going out of my paycheck and into savings, and it was going to be there when I was ready to retire. And I sort of forgot about it, other than occasionally looking at what it was invested in. And then when I did change employers, sort of thinking about, okay, what am I going to roll that into? What makes sense for me to roll that into? Should I be in a target date fund? What should I be in? And then when I went to law school at night, I was working during the day, and I started working as a paralegal for a mutual fund administration company. And my job was to write prospectuses. And so I learned very quickly about disclosure and what disclosure is and what it is supposed to be, what it's supposed to be communicating to the investing public. And that was part of my job. And so I'm a big believer in disclosure. I think having the ability to understand what you're buying and how it interacts with other market instruments is very important. One thing that struck me when the prior panel was speaking was there's a form out there now that all advisors and broker dealers have to provide, and that's Form CRS, Client Relationship Summary, and it has conversation starters. I think this is, as a lawyer who has to create it, I'd rather not have to do that for everybody, but I do think it's a great way for people who maybe are just starting to work with a professional to really ask the right questions and understand how that professional is paid, what their conflicts are, what their job is essentially, and how they interact with the investor. So that's sort of my story.
Thank you. That's great. Chelsea?
Yeah, well, my story is pretty similar to Kelly's as well. I did not come from a family that did any investing. Frankly, my parents actually didn't invest until I created Zenith, and then they became clients. But um, really, what it came down to when I learned about investing was similarly, I started investing in my 401k. And after working in public accounting, I decided that I wanted to transition to wealth management. And I remember in my first months as an associate advisor in wealth management, we were going through our portfolios and how we were going to allocate clients. And I was really struggling with how to internalize some of the strategies that we had. So then my coworker was like, "Well, Chelsea, do you invest on your own?" And I was like, "No." And she's like, "Well, Chelsea, how are you going to help other people manage their money and talk about their own investments if you frankly aren't in tune with your own investments?" So she encouraged me to, once I had rolled over that old 401k, to build out my own allocation and come up with my own strategy on how I wanted to invest. And I really kind of struggled with that. But then her next piece of advice was, well, when you're looking at individual positions, think about the long term, right? So do you think that this company will be around 10, 20 years? And then next, take a look at their 10K. And that was really helpful advice just to look at what the financials are, what were some of the risks with the company. These disclosures were incredibly helpful to help me determine what made the most sense on what I wanted to include. So that was my first experience investing, but that really helped me have that hands-on experience, which then just made me a significantly better advisor in the future too.
Thank you. So, Cole, um, so you started early, you had some exposure to investing, but what did you do to help you start your process separately? Like, did your parents sort of talk to you at the dinner table, Cole, you need to start investing in stocks, or did you independently conduct research to understand the markets?
Yeah, it was very independent. I was in a programming program called All Star Code, and the premise of the program is to teach young men of color to learn how to program. And that took place at Goldman Sachs. So in high school, I had some pretty quick exposure to sort of just what was going on in finance. And then you also learn very quickly, as what we were talking about before, there's sort of, long words and complex summaries and phrases and things like that. But the principles can be boiled down to things that are pretty simple. And that's sort of through first generation investors, directly what we teach. Uh, Commissioner Peirce said it before, but not having all of your eggs in one basket and then compound interest and delayed gratification, those things don't change. So that's been something that, we've always kept in mind in terms of the principles of what we teach. Um, but there's so much information out there, really now at every juncture. Earlier, someone mentioned sort of the democratization and how everything's effectively at your fingertips. Stock market participation's actually rapidly increased, and it's important now more than ever to, continue to be educated and just stick to those same principles.
And so I'll throw this out to all of you guys. What have you been your biggest challenges? We heard a little bit about the risks and consequences of investing. Don't give up from the prior panel. But what would you like to share that some of your biggest challenges have been on your investment journey to building wealth?
I think I think one of the bigger challenges for many people, particularly when you're a newer investor, is sort of being able to think long term and recognizing that, as Lori said, you are paying yourself. Um, the there are, particularly when you're first starting out and you've got rent to pay and you've got a car payment for the first time and you have insurance to pay, and it's sort of it's really a lot. It's kind of overwhelming, but you really want to think about the long term and um and invest for yourself first. I will frankly admit that that is not something I was always very good at. That's why investing directly out of my paycheck on a pre-tax basis made sense for me. But there were many years where any other sort of longer term investing was very difficult for me to to do because there's just so many immediate needs for that capital.
Yeah, I
That's
would
a
also add, I think understanding volatility was something that took a bit of time for me to understand. Um, and I think, especially as I've been helping my siblings learn about investing too, especially in the most recent years where we've seen a lot of positive returns in the markets, understanding that that is not consistent, like there will be ebbs and flows, volatility is normal. For a healthy market, and understanding how to deal with your own mindset in those positions, like remembering what your investment thesis is, your long-term goals, all of that was something that I had to learn so that I felt more confident as an investor.
Cole, would you like to add?
Yeah, just tuning out sort of the risk-loving behavior. Pop culture, especially I think in younger generations, has sort of like glorified this, extremely successful like risk-loving behavior, and it I guess for some it works out, but the stories obviously they don't tell are the ones where it doesn't work out. So continuing to tune that out is kind of been the biggest thing because it a lot of the students we teach their first and sort of only exposure to investing is that. So effectively having to sort of recode the mind of like this is delayed gratification. This is something that takes 30 or 40 years from the education side has been a challenge. But just, having the proper channels for sort of information and then also on top of that, um, you know, following the right sources.
And these points are great. I like to end with risk tolerance. I think we don't talk enough about risk tolerance. Sometimes we want to be aggressive to get at the highest return sometimes. So how have you guys taken into consideration or learned about risk tolerance on your investing journey? Kelly?
Um, I think part of my job has always been around disclosure. And so I draft risk disclosure, which has really meant that I need to understand the instruments that are in a portfolio where I'm drafting the documents for that portfolio. And that has helped me really understand sort of the risk of individual instruments. And not everyone obviously is gonna have that sort of experience. I think that I do think that I sort of fall into the traditional rubric of as you age, you really want to think about maybe downshifting on your risk and thinking a little bit more about some level of certainty in maintaining your principal. I have two young adult children who are now out of college, 529 plans in target date funds. Absolutely did that, right? Like when they were babies, it was high risk, high growth. And as they got closer to having to matriculate, it went down. I believe that that is for many, many people the right way to approach the market. And I think many participants, whether it's broker dealers, advisors, mutual funds, ETFs, they have so much information out there on their sites, not only on investor.gov, but on mutual fund websites and things like that, where you can access information about risk and really educate yourself.
That's great. Cole, did you want to share?
Yeah, absolutely. So, as sort of mentioned earlier, the program we run, we give $100 to students in sort of portfolios already made, and we do that based on a list of securities that we provide to the students. And just in terms of risk, they're all, what you would sort of deem as, what you would sort of buy when you're older. So they're sort of lower risk. One of the points someone brought up earlier was one of the bigger risks that you can take is not investing at all. And no one says they wish they would have started later. So the crux of what we're trying to do is considering we work with, predominantly underserved communities is trying to get folks invested in the market at all, right? So for us, we sort of emphasize low risk, buy and hold. This is your retirement portfolio if you buy more of this. you should, generally speaking, be in a good spot. So for us, we've always preached low risk, highly diversified, dollar cost averaging, and sort of don't panic, obviously, when volatility hits. So for us, we've always preached, sort of low risk. This is what you should be doing to save for retirement, as opposed to doing anything else.
That's great. Chelsea, would you like to wrap us up?
Yeah, absolutely. So I think it's important to think about your liquidity needs and your time horizon are really spot on. And being thoughtful around the types of accounts that you're investing in, where especially if you're in your 20s and 30s and you're investing in an individual retirement account, you probably have a longer time horizon. So you may be more comfortable taking on more risk in that account, more so than, let's say, a brokerage account, depending on your preferences. So it's important to understand the type of account that you're investing in, when you could potentially liquidate it, because that could impact your risk tolerance for that account. But understanding that you don't necessarily have to have the same investment strategy for all of your accounts. So you can have a more aggressive or a more risk on approach in accounts that have that longer time horizon versus ones where you may consider it if you want to purchase a house or if you need a new car in the future, right? Because you have that flexibility, maybe you want to take on a bit less risk in those accounts, because I'm sure you'd probably be upset if you were ready for your down payment and now your principal has come down significantly. So it's understanding the type of account that you're planning to invest in, your time horizon, and when you'd have the potential need for liquidity.
Thanks. We do have a question in the chat box that I like to read, and any one of you guys can answer. With the growing popularity of fractional investing and mobile trading apps, how do you view their impact on new investors? Do I moved a little fast. Do you think these tools can serve as a positive way to begin investing responsibly, or are there risks that might encourage more speculative behavior instead? And then there's another question on how do you recover from panic mode during volatility?
Hmm.
So
Um,
the first
yeah,
one first.
yeah, I'll tackle the mobile trading apps and robo advisors. Those entities are those apps are or should be um, uh, operated by registered entities, whether it's broker dealer or an investment advisor. And those entities are subject to disclosure obligations and general regulatory scrutiny. Um, you should take the opportunity through those apps. When I'm out on those apps, there's plenty of education on them. And you shouldn't just be using them to go in and just trade. You need to sort of go through the process, go through your risk tolerance questionnaire, answer it honestly, and really think about what the app is providing for you, because the algorithms are very complex and very able to help you sort of get into your sort of risk tolerance band. Once you're in that risk tolerance band, even though you're dealing with an app, the entities behind it should be considering, particularly if it's broker dealer, whether that's suitable for someone in your sort of risk tolerance band. And if you're investing consistently out of your risk tolerance band, it should be, sending a pop-up saying, "Are you sure?" The other thing that I think is not a bad idea, although I will defer to Cole and Chelsea on this, is I also think that sometimes people who are learning investing might want to have a small sliver of their investable assets, maybe it's 10%, that they can use to maybe go into something that's a little bit out of their risk tolerance. Maybe it's a little bit of, much more aggressive and that they're interested in um, recognizing that it might be out of their risk tolerance. But sort of the bulk of your assets are invested long term, but you still have this little bit. I think that those apps can facilitate that approach.
Chelsea,
Yeah.
did you want to add?
Yeah, I was going to say, I think that's spot on. And I know for a lot of fractional share purchases that are allowed now, it's just really been able to provide more access to people so that they can invest too. So instead of trying to save up, hundreds or thousands of dollars to make sure they can just buy one share. It's really been able to give more people access to investing. But as with everything, doing your research, making sure you fully understand and have a properly balanced portfolio is important.
Thank you. And thank all of you guys for just a wonderful presentation and sharing your personal stories with us on how you began to invest. I feel encouraged by the insight that you guys have shared. So thank you all. Thank you. Next up, we have a speak. Bye bye. Next up, we have a speaker that I met, Janelli Espinal. I met Janelli probably over 2 months ago at a conference, and she stole the show. And so I was delighted when I reached out to ask her if she would join us for the Investor Spotlight today and share some words of wisdom to us regarding investing. Janelli?
Hello, I'm so excited to be joining you all. All right, I'm going to go ahead and share my screen here. Y'all let me know if you can see it. Is that good there?
Yes, yes.
Amazing. All right. Well, thank you so much, Pamela. As was shared, my name is Yaneli Espinal, and I am a financial educator. That is the title I use. A published author, and I also work at a nonprofit organization that promotes financial literacy education in our public schools. And I create content on social media as well. So I want to tell you a little bit about my backstory and how I got started investing. And then, of course, if there's questions, I'm happy to answer them. So I'll start with my early memories. I grew up in New York City, in Bushwick, Brooklyn, before the changes in the neighborhood. So my memories of Bushwick were not, bakeries and art galleries. We didn't have that. When I was growing up, it was like block parties, and the fire hydrant, which we call the pump, would get busted open and everybody would just run outside in the hot summers. And so while I tell people like growing up in New York City definitely gave me so much grit, but being in like the capital of finance in the world, right? Like Wall Street was just probably 20 to 30 minutes away from where I grew up, my neighborhood. But it was so far, it could have been, miles and miles away, because I just never had any like exposure to that world or to thinking about capital markets or the way money moves in the world. My exposure to the world of money was cash. My parents were a cash only couple. We were a cash only household. My parents immigrated to New York City from the Dominican Republic, and they didn't really know anybody. They didn't speak English, and they never went to school beyond the third grade. So I am not only a first generation American, also first generation college grad and first generation investor, having to sort of figure out money on my own and unlearn a lot of the, I would say, bad money habits that I picked up in my household. And that's not to blame my parents or to say that they were bad at teaching us about money. It's just that they themselves never got a financial education. So when they got here to this country, they kind of did the best they could with what they had. And, for them, that was just managing everything with cash. But of course, there's so much risk that comes with cash. Of course, if there's a fire, your money's gone. If your money gets stolen, if inflation every year is increasing and you're losing the value of your purchasing power of your money. So we never really talked about any of that. And growing up, money just wasn't a topic that we would discuss. It was just very hush hush. It was it was a point of contention because usually there wasn't enough money to pay the bills or to buy groceries. And so my parents often, I wouldn't say fought, because if they were fighting, I didn't see it, but they were really negative around money. It was, there's never enough money. No hay dinero was the phrase. No, there's no money. And, there's not enough to pay all the things we have to pay for. But on top of that, my parents have 9 children. So I'm the 6th of 9. And, growing up, even though we didn't really have a lot of money, there was a lot of pressure to perform academically. My parents were like, we didn't immigrate to this country and give you opportunities and access to a better life so that you could squander it. The expectation is that you come home with straight A's. And that was something that they really, really, really hammered home, because their parents, my grandparents, never had a chance to leave the farm where they were born. So for them to never leave the farm, and then my parents to be able to leave their home country to come to the US, but never really get an education beyond the third grade, the real big goal they had for their kids and for their future generations was education is the key. So they pushed that on me and on my siblings so much. And it really did work. I mean, I was very academically inclined. I was very interested in performing well in school. Like I was always nerding out, reading every, chapter book I could get my hands on. And it paid off in high school. I got a full scholarship to Brown University. And that really was sort of like this huge life-changing experience to get plucked out of, my bedroom that I shared with all of my sisters, with 4 sisters, and be in my dorm room where I only had to share with one other roommate and have, independence, my own space, to be around people from all over the world. And it was really a challenge for me. But one of the biggest things that I continued to do was not talk about money, because I didn't talk about money growing up and I didn't want to talk about it in college. I didn't have enough money to buy my textbooks, to pay for a laptop, to buy school supplies, to decorate my dorm room, to be social, to have a social life in college. And I didn't really know what to do. I couldn't talk to my parents about it because I knew that they didn't have money to help me. I couldn't talk to my friends about it because I didn't want them to think I was poor. I didn't want them to feel bad for me or to be that girl who never had enough money. And so I went ahead and I opened my very first credit card on campus freshman year. And this was before the Credit Card Act of 2009, when you could get a credit card in exchange for signing up and getting a free t-shirt, or for getting a slice of pizza in exchange for a credit card application. Those things don't happen anymore, but at that time, it was very easy to get a credit card. And so I piled on a lot of credit card debt, and that was my entry point into the world of money. I graduated college with a ton of credit card debt, like over $20,000 of credit card debt. And I started teaching. My first job was a 4th grade teacher in Brooklyn, New York, right where I grew up. And I just love teaching. Like, it was so much fun. To this day, I still think, I am a teacher at heart. It's what I do. But my paychecks were pretty small and my debt was pretty high, and I couldn't manage to pay my rent, my bills, buy groceries, pay for transportation, also help out my family from time to time. And so I got really frustrated. I would often go home and like cry at my desk because I didn't know how I was supposed to manage all the credit card bills plus my bills at home, my rent, and all of the things. And so one day I walked into a Dwayne Reed, which is like the CVS, Walgreens kind of a pharmacy and convenience store in New York City. But at checkout, when I was about to pay, I saw this book stand out to me, and it was Women and Money by Susie Orman. And I tell people all the time, I'm like, that book, it cost me $9.50. Best $9.50 I've ever spent, because it has really, really paid its dividends. From that book, I was able to create a debt repayment plan. I paid off all the credit cards. I started saving in the right kind of savings account. And I decided that I wanted to become the first investor in my family, and I was determined to do it. So from there, I kept on going, right? It was the first book that I read, but it definitely wasn't the last. I read all of the classic money, personal finance books I could get my hands on. And probably the most impactful to my investment strategies is The Simple Path to Wealth by J.L. Collins, who really pushes passive investing, not active, and just really low costs, low fees. So those are the big pillars of my investment strategy. But it was a whole new world to me, the world of money. And I felt really frustrated. Why didn't anybody teach me this in school? Like, I did so well in school. I excelled in all the AP classes. I did all the things. If I had had a personal finance or money management class, I would have done so well. But nobody ever gave me that opportunity to learn about this world of money and the markets. And so I felt a little bit frustrated and defeated, but I said, you know what, I'm going to go ahead and make sure that nobody else can say that younger generations won't be able to say, well, I didn't know this. So I decided to create content to help others learn what I had taught myself. So I decided to start a YouTube channel called Miss Be Helpful. And then a year later, I started an Instagram, Miss Be Helpful. And I just started creating videos and content around, how I started investing. What's the difference between an ETF and a mutual fund? What's the difference between the expense ratio and, the other types of fees that you might see on your investment statements. And so I just started really explaining basics, and the audience just kind of grew organically. I didn't really know anything about marketing or promoting it, but organically people began to comment on my videos. Like, this is really helpful. This is incredible. And we're not learning this in school or talking about it at home. So finding it online is really how most young people today are learning about it. They're going on TikTok, they're going on YouTube, and they're learning about money from financial influencers. And so I realized right away, okay, I'm sort of have this responsibility because it's impossible to teach in 10 minutes or 11 minutes videos, everything that you need to know. And so I decided, okay, I want to put this all in a book as well. And so last year, I published my book called Mind Your Money to tell a little bit of my story. And then I realized, this is great and everything, but social media content isn't going to reach everybody. And so the only real way to reach everybody and make sure that the next generation does not miss out on this education like I did, is to make sure it's required as part of the public education system. So now my work is dedicated around meeting with senators, representatives, governor's offices across the country at the state level to advocate and convince them, hey, financial literacy is critical. It's so important. Let's get a bill introduced in the legislature and let's get the governor to sign it to require a full semester class in high school, part of graduation requirements, that is dedicated to just personal financial literacy. And so when I started this work in 2018, there were only 5 states that required a full semester class. And today, in 2024, there are 26 states.
Oh, that's great.
The most recent state being California, which is really incredible. And currently I'm working on legislative efforts in New Jersey, Texas, and in Colorado. All right, so how did it all start? What did I do? How did I get convinced to take some of my little bitty money and put it in the stock market? So it all started with a 403B plan. I was a teacher, like I said, and we were sitting down in a professional development, teacher training workshop. They were telling us about all of the human resources available to us, the healthcare plan and the insurance, the life insurance, and they mentioned the 403B plan. Now, immediately I was like, I'm not doing any of this. I don't want them to take a piece of my paycheck. I need my paycheck. But the teacher who was teaching down the hall from me, she immediately turned to me and said, oh, honey, you want to sign up for this? You're going to want to sign up for this. And I was like, oh, really? And she's like, yeah, this is going to be really, really important for you to grow your money throughout your career. And I was like, oh, okay. And so I really trusted her. She took me under her wing and taught me a lot about classroom management. And, she's a veteran teacher. So I said, okay, I'm going to go ahead and sign up. But I didn't know the paperwork was so complicated. Like when I tell you, people think, oh, it's so simple. You just sign up through your workplace plan. But you had to fill in time horizon, risk tolerance, asset allocation, liquidity. I don't know what any of those words mean. And don't know anyone who talks about that in my family. I didn't know anyone with a 403B or a 401k. So I copied her entire application. I don't recommend this, but that's what I did. I was 22 years old. I was clueless. So I just looked over at her paper and everything she bubbled in, I copied. And I remember to this day vividly because I was so scared. I was like, what am I doing? What does this mean?
Mhm.
She typed in she wrote in 7%. And so I wrote in 7%. So that means 7% of my salary every year was being contributed into this 403B plan. And she bubbled in moderately aggressive mutual funds or moderately aggressive index funds. And so I bubbled that moderately aggressive funds. So at 22, without knowing it, I jumped into the stock market through a 403B plan and got lucky because I got some moderately aggressive funds, which means that they had more equity than fixed income, than bonds, and were pretty low cost because it was the provider of this 403B plan was Vanguard, which is a pretty well-known leader in the industry for low cost options. And so that's how I started. And then we had another workshop where we were talking about all the benefits. And this example is the first reason I decided to invest outside of my 403B plan as well. And so they said, you have 2 choices. You can either take $1 million with you today when you leave school, or you can take a penny and we're going to offer to double that penny every day. And then you'll come back after 30 days. So after 30 times of doubling your penny, you can come back in and collect your money. And they had a quick example. So, first day you're going to get a penny, but then the first time on day 2 you come in, they double it, you get 2 cents, then 4 cents, then 8 cents. And so I was like, oh my God, I think I want the million. I don't want to wait around for this little penny to keep growing into 20 cents, 50 cents, 30 cents. It's going to take forever for me to make money. And so me and probably the majority of the other teachers all opted to take the million and walk out. Why would you not? And then they went to the next slide. And the next slide says, if you chose to take 1 million today, you will basically have turned down $9.7 extra million. Because the total after 30 times of doubling that penny is $10.7 million. And I just couldn't believe it. I was like, this has to be wrong. It can't possibly be true. This can't be real math. Like, it just does not compute. My brain can't understand how it works. And so I just kept like staring at the numbers. And then the exact same teacher who sat next to me turned to me and said, hey, listen, this is because the return rate is 100%. The rate that of growth that you're getting is 100%. Every time you come back the next day, it's 100% return. You got the exact amount you put in. And I was like, okay, so where do I go to get 100% return on my money? Like, I want to sign up. And that's when I started like learning a bit more. Well, when you go to the bank, they don't give you 100%. They give you 0.01%. And so I just started to realize, okay, well, I'm saving the wrong way. I had my money in a traditional savings account. I immediately took my savings and moved it to a high yield savings account. For those of you who don't yet have a high yield savings account, obviously today you can get one for 4% or higher, depending on which institution. But obviously if it's an FDIC insured high yield savings account, that's the best place to park cash. So I parked my emergency savings cash there. And then once I had my emergency savings goal, I then decided to go and invest outside. So my favorite tool that I've used then, that I still use every so often now, to either play around with the numbers myself or to show someone else the power of investing, is to pull up the compound interest calculator and just start typing in the numbers. I said, okay, what if I start with $200 and I add, 200 from every paycheck. So maybe $400 or $500 every month. And I do this for my working career, 40 years. In the markets, generally on average, anywhere from 8 to 10%. So let's go with 9 in the middle, hit calculate. And now you have over $1.5 million throughout your career. Most people that I talk to in my community, my neighborhood, in my family, they'll tell you that it's not in the cards for them. They're never going to become a millionaire. It's just not going to happen. And I show them this. I say, well, go to investor.gov, scroll all the way down to the red box that says compound interest calculator, and just play around with the numbers, and you will see that you can become a millionaire throughout your working career. It is possible. And somebody asked me to go back a slide, so I'm just gonna go
She
back.
wants you to go back to the slide with your books. And I love that you are using SEC resource,
Yes, my favorite.
investor.gov. And unfortunately, we're going to have to, do you have any closing remarks that you'd like to add? I mean, I love hearing you speak. You're so inspirational. But we have just one more little speaker right after you.
Sure. Yeah, no, I
Parting
mean,
words.
one of the biggest things I will say is a lot of the resources out there and the people in the space can be pretty intimidating because of the language that they use, because of the terminology, the vocabulary. But give this as a gift to yourself, like that you are not going to quit, that you're really going to wrap your mind around it. And there's more resources today than ever. Like, if there's a term that you don't understand, there's Chat GPT today. I did not have Chat GPT in 2014 when I was trying to figure out what the heck a mutual fund was. And so if there's any language that you don't understand, copy and paste that language, go into ChatGPT. Please explain this to me as if I were 15 years old, 14, 13 years old, so I could understand it better. And the more you start to wrap your mind around some of the trickier concepts and break them down, you'll start to shy away from some of that language. When I talk to people about investing, I don't use language like risk tolerance, asset allocation, liquidity. I don't say that because I think it's more off-putting. It makes them not trust me because they're like, what is she talking about? Oh no, that's not for me. So I try really hard to make it approachable in my content. And if I can talk to my girlfriend about this at a coffee shop and she can understand, then I'm successful at educating anybody really, or my friends, about this. So I would say, yeah, don't give up, be relentless. Use resources online today to like break down to the basics. And if there's somebody out there that's really successful and you really admire them, don't be afraid to reach out and ask. I have had quite a few people reach out to me and say, hey, can you explain this to me? Can you send me resources around this? And I'll send them articles or videos to help them understand it better. Because the longer you wait to really wrap your mind around it, the more time you're wasting that you're not in the market benefiting from a lot of the growth that the capital markets allow us to take advantage of.
Well, once again, very inspirational, excellent. You've encouraged us, you provided resources, and I just can't thank you enough for joining us and sharing your wisdom. Really, you've learned a lot in such a short period of time, and your advocacy for people to want to also learn. Thank you so much for joining us
Thank you
today.
so much for having me. It was a
Thank,
pleasure.
thank you. So our last speaker, where to begin? Janelli has started the process on where to begin through her financial education efforts. We want to call back Lori Schock from the Office of Investor Education and Advocacy to close us out with some tips on where to begin.
All right. Well, that was very inspiring. So, you know what? We are going to move through this quickly on my end. So, one thing, this is going to have a QR code on it. I encourage everybody who stuck with us this long to use the QR code so that you can go directly to the resources that I'm talking about. Everything I'm talking about comes from investor.gov. Look, so many of these topics have been covered earlier today. A couple things I want to re-emphasize. How about that? You need to have a financial plan, okay? And so when you have a plan, when volatility hits, you don't panic. So it's plan it, don't panic. Um, we're starting early. We're setting aside our emergency fund. Then we're starting to get into the markets, being diversified, not having all of your eggs in one basket, um, avoiding fraud by doing background checks, only investing in registered products to start out with. You can get a little bit more exotic as you get into it, get a solid foundation built. But the biggest one is this power of compound interest. Okay. So this is the growth of $100 a month. We talked about that in the very beginning. The difference between a 1% return, which is what you may get on a bank account, versus that 7% return that I talked about, that's inflation adjusted from the historical S&P 500 over the course of 40 years. That's the difference. It's almost $200,000. And imagine if you were, I'm sorry, it's $190,000 if you were investing this on a regular basis and even more, or if you were investing in that 401k or 403b or thrift savings plan where you get a match, you'll have even that much more. That's the snowball effect of compound interest. Again, everything's on investor.gov. I just want to be respectful of your time, but I'll leave you with these graphs here to just have some resources to start with, and read our investor alerts and bulletins, sign up for them if you will. We also do monthly investor quizzes. This is an area where it's time in the market, not timing the market. Directors take articles that we put out, so you won't see it be inundated by information, but you can sign up to have it delivered to your email. It's probably 2 or 3 pieces a month tops. So thank you, Pam.
Thank you, Lori. Hey, while Stephanie comes to close the program out, do you mind going back to the slide with the QR code so
Sure.
people can still access that? Thank you, Lori, so much. Stephanie?
Absolutely.
Yes, thank you all. This was such a great conversation. Every time we engage in a conversation like this, I continue to learn so much, and I hope everyone who joined us today did as well. On behalf of first generation investors, I do want to say thank you to the SEC, Pam Gibbs, Commissioner Purse, Christina Martin Fervita, Lori Schock, and all of our panelists, our speakers, for having us here to co-host this very informative event and important conversation. And thank you to all the guests who joined us today. We really appreciate you taking the time to join us this afternoon. If you would like more information about investing or capital markets, please make sure you use these resources. Visit investor.gov, sec.gov. And if you would like to learn more about first generation investors, please feel free to visit www.firstgenerationinvestors.com. Thank you.